Most people are misreading XRP right now. While most investors focus on price action and daily headlines, a newly leaked attendee list from one of the most exclusive private gatherings in the world is revealing something far more important: the network of people surrounding Ripple. In this video, we're going to break down the leak, examine Ripple's connections to government officials, Silicon Valley power players, and financial institutions, and explore why some investors believe these relationships could matter more than short-term market moves. The leaked list reportedly comes from Dialogue, a highly exclusive invitational-only forum founded by Peter Thiel and Auren Hoffman. This isn't a public conference. These are closed-door discussions attended by some of the most influential figures in technology, finance, politics, and policy. The reported 2026 attendee list includes current and former government officials, senators, technology executives, venture capital leaders, and individuals who have direct or indirect connections to Ripple. And that's where the story becomes interesting. Because when you start mapping these relationships, ladies and gentlemen, a pattern begins to emerge, one that stretches back more than a decade and places Ripple in circles very few crypto companies have ever assessed. If you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the market. Let's talk about the bigger picture. See, for more than a decade, Ripple has occupied a unique position inside the digital asset industry. Unlike many crypto projects that emerge from anonymous developers or grassroots communities, Ripple consistently attracted individuals with backgrounds in banking, government, venture capital, and institutional finance. Let that sink in, marinate on that, ladies and gentlemen. That alone makes Ripple very different. Most startups spend years trying to gain access to policymakers. Ripple seemed to attract them naturally. Former regulators, former treasury officials, academic economists, Wall Street veterans, technology executives. And over time, a pattern began to emerge. The company wasn't merely building technology, it was building relationships. And this is what most people miss. When investors analyze digital assets, they often focus exclusively on charts, technical indicators, and market cycles. But financial history teaches us a very different lesson. Major monetary shifts rarely happen because of technology alone. They happen when technology intersects with institutions, and Ripple has spent years operating exactly at that intersection. The leak that changed the conversation. See, recently, a data breach exposed something that immediately caught the attention of XRP observers. The leak reportedly revealed attendees connected to Dialogue, a highly exclusive invitation-only gathering founded in 2006 by Peter Thiel and Auren Hoffman. Dialogue isn't your typical conference. There are no public live streams, no viral keynote speeches, no media circuits. Instead, participants gather behind closed doors to discuss geopolitics, technology, strategy, economics, and the future. The 2026 retreat near Dublin reportedly included more than 220 attendees, and the names were extraordinary: current and former government officials, technology leaders, financial power brokers, policy influencers, some of the most connected individuals in America. And hidden among those connections were several names that XRP followers have been discussing for years. But here's where it gets interesting. Many of these people aren't connected by chance. They're connected through decades of overlapping relationships. Peter Thiel and Ripple's early roots. See, to understand why this matters, we need to go back to Ripple's earliest days. Before Ripple became Ripple, it was known as OpenCoin. And one of the earliest backers came through Founders Fund, the venture capital firm created by Peter Thiel. Thiel's influence in technology circles is difficult to overstate. He co-founded PayPal alongside a group that would later become known as the PayPal Mafia, a collection of entrepreneurs and investors who helped shape modern Silicon Valley. The network eventually produced companies, venture funds, and leaders that influenced everything from artificial intelligence to defense technology. Ripple's connection to that ecosystem goes back to the beginning, and that historical detail becomes increasingly important when examining how Ripple has consistently found itself connected to influential circles: short-term noise, long-term structure. That's the distinction many investors are watching. Because while markets focus on daily price movements, institutional networks often develop over decades. Susan Athene, the hidden connection. Among all the names discussed, one stands out: Susan Ethy, a renowned economist, former chief economist for the U.S. Department of Justice Antitrust Division, Stanford professor, and according to multiple discussions surrounding Ripple, a long-standing board member. What's fascinating is that many casual observers aren't even aware of her involvement, yet her credentials place her among the most respected economists associated with any major cryptocurrency project. That's so massive, ladies and gentlemen. Let that take in. But the real significance goes beyond titles. She helped bring rigorous economic analysis into a sector often dominated by speculation. Back in 2018, she collaborated with Robbie Mijatnik on a framework attempting to value digital assets. Today, Robbie leads digital asset initiatives at BlackRock, the world's largest asset manager. That connection alone highlights how early Ripple's ecosystem became intertwined with institutional finance. Now, this is what most people miss. The people evaluating digital assets at the highest levels often aren't asking the same questions retail investors ask. They're asking infrastructure questions, liquidity questions, settlement questions, cross-border efficiency questions. And that's exactly where Ripple has focused its efforts. So what Ripple is actually trying to build, ladies and gentlemen, according to Ethy's public explanations, the XRP ledger was never intended to be limited to XRP alone. Instead, it was designed as a multi-currency system, a platform capable of facilitating movement between many different forms of value: national currencies, stablecoins, tokenized assets, digital representations of real-world instruments. The goal wasn't replacing every currency. The goal was connecting them. Think about countries suffering from unstable monetary system: Argentina, Venezuela, other regions facing persistent inflation. For citizens in those economies, holding foreign currency isn't always practical. Ripple's vision attempts to create efficient pathways between monetary systems, and XRP serves a unique role inside that architecture, not necessarily as the final destination, but as the bridge. See, history provides an interesting comparison, ladies and gentlemen. During the rise of the Roman Empire, one of Rome's greatest advantages wasn't military strength alone. It was infrastructure. Roads connected distant regions into a unified economic network. Merchants could move goods faster. Information traveled more efficiently. Trade expanded dramatically. The roads themselves weren't the destination. They were the bridge connecting everything else. Ripple supporters argue that XRP could potentially play a similar role inside digital finance, not replacing currencies, connecting them. Whether that vision ultimately succeeds remains uncertain, but the comparison helps explain the strategic thinking behind the project. Let's talk about the government connections for a second. One recurring theme surrounding Ripple is its unusual concentration of former government officials. This isn't typical startup behavior. See, many startups avoid regulators until they absolutely need them. Ripple appeared to move in the opposite direction. Over the years, the company attracted individuals with backgrounds in treasury departments, regulatory agencies, and financial policy making circles. Craig Phillips is often one example frequently cited. Others have moved between government institutions and Ripple-related initiatives. Critics view this as evidence of insider influence. Supporters view it as evidence of strategic preparation. Regardless of perspective, the pattern is difficult to ignore, and it becomes even more relevant as government worldwide begin establishing digital asset frameworks, because regulatory clarity often determines where innovation remains theoretical or becomes mainstream. The Clarity Act and the regulatory shift. That brings us to one of the most important developments discussed in this video: the push for digital asset regulation in the United States. Lawmakers increasingly recognize that uncertainty creates risk for businesses, for investors, for innovation. Senator Tim Scott and others have emphasized the need for clearer guardrails, rules defining where securities and commodities begin, rules allowing innovation while maintaining market integrity. The significance extends beyond crypto. National competitiveness may be at stake, because while Washington debates frameworks, other nations are moving aggressively into digital finance. And that's where the global competition story begins. See China's digital yuan push. China spent years developing the digital yuan and state-backed digital currency designed to support domestic and international payments. The broader objective isn't merely modernization, it's influence. Cross-border payment systems are strategic assets. Countries that control payment infrastructure often gain economic leverage. As adoption discussions continue worldwide, policymakers increasingly frame digital assets as a national security issue rather than simply a technology issue. But here's where it gets interesting. The debate is no longer whether digital finance is coming. The debate is who will shape it. And that's a fundamentally different conversation. Financial history often offers another lesson. In 1944, representatives from dozens of nations gathered for the Bretton Woods Conference. The agreements reached there helped define the post-war monetary order for decades. The meeting wasn't important because of headlines. It was important because it shaped infrastructure, rules, settlement systems, global financial relationships. Today's digital asset debates are obviously different, but they reflect a similar reality. The biggest chances often happen long before the public fully notices them. XRP stablecoins are a common misunderstanding, ladies and gentlemen. One of the largest misconceptions about XRP involves stablecoins. Some investors assume stablecoins compete with XRP. Others worry they reduce XRP's importance. But according to longtime XRP ledger contributors, that's not how the system was designed. The ledger supports many assets simultaneously. Stablecoins increase utility. Additional currencies create additional trading pairs. Additional trading pairs create additional liquidity opportunities. And XRP's auto bridge functionality allows it to facilitate transactions between those assets. In simple terms, more assets could potentially mean more pathways. And more pathways could potentially mean greater demand for bridge liquidity. Prices reacting, systems evolving. Those are not always the same thing. See, imagine a medieval marketplace, ladies and gentlemen. Hundreds of merchants arrive carrying different goods, different weights, different measures, different local currencies. Commerce becomes easier when a common exchange mechanism emerges. Not because every merchant wants the same goods, but because they need an efficient bridge between them. Supporters argue XRP attempts to perform a similar function inside a digital marketplace of assets. Again, that's an analogy, not a prediction, but it helps explain the economic logic behind the network. Another analogy might be the shipping container revolution. Before standardized containers, global trade was fragmented and inefficient. After standardization, goods moved faster across vastly different transportation systems. The container didn't replace ships, trains, or trucks. It connected them. Ripple's broader vision resembles that concept. A system focused on interoperability, connecting rather than replacing. And that distinction matters. Political money and crypto influence, ladies and gentlemen, this is a big thing to pay attention to. See, in this video, I also want to highlight another reality. Crypto is becoming increasingly influential in politics. Large campaign contributions, industry lobbying, policy advocacy. Supporters argue these efforts keep innovation inside the United States. Critics argue they increase industry influence over legislation. Regardless of viewpoint, one thing is becoming clear. Digital assets are no longer operating outside the political system. They're becoming part of it. And that shift may have profound implications for future regulation. So the real question investors should be asking, ladies and gentlemen, after examining the leak, the networks, the legislation, and the technology, one question remains. What exactly is Ripple becoming? A payments company? A digital asset infrastructure provider? A bridge between traditional finance and blockchain systems? Perhaps elements of all three. The leaked attendee list does not provide or prove future success. It doesn't guarantee adoption, and certainly doesn't guarantee price appreciation. But it does reveal something important. Ripple's network extends far beyond crypto, ladies and gentlemen. Write this down. This is massive. Into government, academia, technology, finance, and policy. Whether the ultimately translates into long-term value remains one of the most closely watched questions in the digital asset industry, ladies and gentlemen. See, as always, investors should separate speculation from structure, separate headlines from infrastructure, and separate short-term market emotion from long-term institutional developments. Because throughout financial history, the systems that eventually matter most are often built quietly before the public fully understands their significance. The leaked dialogue attendee list may simply be another interesting story, or it may be a glimpse into the network shaping tomorrow's financial architecture. Only time will tell. If you enjoyed this deep dive, make sure to like the video, subscribe to the channel, and share with anyone following the future of XRP, Ripple, and digital assets. And remember, short-term noise, long-term structure, prices reacting, systems evolving. Always pay attention to what's quiet, ladies and gentlemen. I'll see you in the next one. Hope everyone's having a great day today, ladies and gentlemen. I want to welcome all the new members of the Patreon, all the new members of the membership channel. As always, ladies and gentlemen, one good tip in the pits can easily pay for your entire year subscription to the Crypto Public Desk Monthly. If you're looking for the deeper macro research, if you want to learn how to take advantage of everything that we go over, come and join over 600 active traders and vets inside the Crypto Public Desk Monthly. I always tell you this, and this is really, really important. Death by 1,000 headlines, death by 1,000 paper cuts. The market is ignoring the biggest risk right now, as far as I'm concerned, ladies and gentlemen, in front of it. Okay. And this is something very, very important. This is how we don't get caught up like sushi, by paying attention to what's quiet, what's boring. Okay. This is where Gucci conviction and Gucci clarity comes from, because everyone's celebrating. AI stocks are ripping, semiconductors are floating higher, retail traders are convinced the path of least resistance straight up. And honestly, that's exactly what makes me nervous. Yeah. Because when everyone starts looking at the same thing, the thing nobody's looking at becomes the real risk. Because when we were paying attention to what's quiet, is loud, that's normally our cue to be exiting stage left. And right now, the entire market's behaving as if one trade explains everything. AI, that's it. That's the trade. And whether you look underneath the surface, the concentration is becoming almost absurd. The narrative says AI spending is unstoppable. The narrative says hyperscalers will continue spending. The narrative says semiconductor demand is infinite. The narrative says everything and every earnings report will just justify every valuation. That doesn't even make sense when you think about what's happening in the market right now. It doesn't. But this is the euphoria. But markets don't break because people are looking at the wrong thing. Markets break because people stop looking at the second order effects. This is so important right here. It really, really is. And that's where things get interesting. I want to start first with oil. Everyone expected geopolitical tensions to create another major energy shock. Instead, negotiations continue. Comments coming out of the region suggest we're entering a prolonged period of talks rather than immediate escalation. So here's what most people are really missing. The oil market continues and currently has an enormous speculative short position. Think about that, okay? A huge amount of capital is already betting on lower prices. And when positioning becomes that one-sided, the market doesn't need good news to move higher. It only needs less bad news. It's like musical chairs. And that's exactly the environment we're sitting in. Because negotiations continue and disruption risks remain a negotiating tool rather than a reality. Oil doesn't necessarily collapse. No. In fact, the real risk actually may be that too many people are leaning the same direction. Yeah. And whenever positioning gets crowded, price can become disconnected from expectations very quickly. And this is how people get chopped up like sushi, unfortunately. Again, this is, if you follow this thought, it's in oil right now. In 08, we saw banks collapse because everyone does the same thing, dumpster diving, doing the same trades. And it's scary. But this is happening again, in our opinion, right now. It's not financial advice, just my own perspective. Anyone retains our organization any capacity. Let me talk about what everyone actually cares about right now. Artificial intelligence. The rally is broadening, not narrowing, broadening. That's important. We're seeing increasingly capable open source models released at an astonishing pace. Model quality continues improving, token costs continue compressing, the technology itself is becoming cheaper, yet spending continues accelerating. That's the paradox. Every economist will tell you that when costs fall, spending should slow, right? But instead, we're seeing the opposite. Companies are spending more. Infrastructure budgets are growing. Hardware demand remains relentless. Why? Because AI is currently operating under a different equation. The productivity gains are arriving faster than cost compression. And until that changes, capital expenditure remains king. That's why semiconductor flows matter. That's why hardware names matter. That's why data center spending matters. Because investors aren't buying today's earnings. They're buying tomorrow's infrastructure. And that brings us to a statistic almost nobody's talking about. Last week, semiconductors focused funds experienced extraordinary inflows, not normal inflows, not healthy inflows, extraordinary inflows. Whenever capital starts crowding into a theme that this aggressively, it creates two outcomes, ladies and gentlemen. Either the market's correctly pricing a massive future opportunity, or expectations have become so elevated that reality struggles to keep up. And history tells us both outcomes can exist simultaneously. The opportunity can be real. The positioning can still become dangerous. I want to talk about currencies for a second. because this is where things start getting really uncomfortable. The US dollar has quietly started strengthening. And at the same time, front-end yields are moving higher. Historically, that combination has not been particularly friendly for risk assets, especially emerging markets. A stronger dollar tightens financial conditions globally. Higher front-end rates tighten liquidity. Normal markets care about that. But right now, nobody seems to care. And that's what fascinates me, because we're seeing a significantly repricing of interest rate expectations. We're seeing movement in the front end of the curve. We're seeing changes in Fed outcome probabilities. Yet equity markets are acting like none of it matters. Why? Because AI is absorbing all attention. The markets have become so focused on one theme that macro signals are struggling to break through. That's not necessarily bullish. That's concentration. And concentration creates fragility. Then we go to positioning. This is where the story becomes even more interesting as far as I'm concerned. Last week, we saw meaningful de-risking from long-short funds. Gross exposure came down. Net exposure drifted lower. Professional money managers actually reduced risk. But sentiment surveys continue improving. Do you understand how bizarre that is? I'll tell you. Institutional positioning became more cautious. Investor sentiment became more optimistic. That's a divergence, and divergence matter, because eventually one side has to adjust. Either positioning rebuilds aggressively or sentiment comes back down to reality. Both cannot continue indefinitely. Now, here's the biggest takeaway. The market is still functioning as a single ecosystem. AI spend, AI infrastructure, AI hardware, AI investment. Everything keeps leading back to the same source. And while that's been incredibly profitable, it also creates a hidden vulnerability. One theme drives performance, liquidity, sentiment, and positioning simultaneously. Every participant becomes more dependent on the same outcome. The market starts looking diversified, but underneath the hood, it's all connected. And that's exactly why the next few weeks matter very much. Not because of headlines, not because of social media narratives, but because we're about to find out whether the fundamentals can continue justifying the expectations. Because eventually every story reaches the same destination, the numbers. And when the numbers arrive, narratives either get stronger or they get exposed. Ladies and gentlemen, I am trying to take the PhD out of PhD here saying this. There's divergences happen that never really happened. When we talk about the AI play, we're seeing it first really in the commodities that are being sucked up at copious amounts to fuel what's happening. So it's not like that's going to stop because there's a race for dominance in the space, okay? That's one caveat to this whole situation that people, as far as I'm concerned, and investors, and I spend all day on the phone with family offices and hedge funds going over this and why. This is new to this space, new to the investing arena. You've never had these things divergence like this. It's very different right here, right now. Everybody always assumes that tomorrow in finance will look like yesterday's cycles. This one's not going to do that. And anyone who's thinking it's going to do that is going to be grossly disappointed and maybe cut up like sushi and devoured, because these plays are happening. The commodities backing the plays are being consumed. It's happening. Nothing's really going to stop that because it's a new type of Cold War. It's going to go on. The way you prosper here is very, very simple. With a plan. A rigid plan. Money management, discipline. No leverage so you don't get cut up like sushi. Ladies and gentlemen, if you want to learn how to take advantage of what I'm talking about, see, I tell you how we find what we're looking at inside the Crypto Public Desk Monthly in our Patreon. We show you what plays we're playing, the price points, the levels, the logic behind everything. So if you want to learn how to trade, if you want to learn how to invest, come and join the Crypto Public Desk Monthly and start our Patreon. One solid tip in the pits pays for your entire year subscription. Come and join over 600 active traders and investors who are already learning. Because look, nothing about today's cycle will ever repeat itself again. The fact that information can be spread so fast, so quickly, is new. But what's fueling all of this is very, very different. Capital has to find new plays to take advantage of right now. That's why if you want to learn how to trade equities, futures, spot, crypto, everything, and interpret all this, come and join the Crypto Public Desk Monthly. You'll learn what we were taught in the fall of the New York Mercantile Exchange. And it's really, really important because being a financial mercenary is freedom. I don't expect any cycle to be similar to what is going on right now. None of this is financial advice, just my own opinion, and I retain to myself for our organization and capacity. But you got to understand something. People can tell you that these trades don't make sense, and I'll probably agree with you that they don't make sense, right? But the underlying situation, what does make sense is the amount of commodities that are being sucked out of the ground to build this is not changing today or tomorrow. So you can sit here and say these numbers don't make sense, blah, 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 blah. And I'll tell you at the end of the day and take the contrarian point of the argument and say, well, you know what? The commodity demand that's happening doesn't make sense either. So you tell me what came first, the chicken or the egg. Tell me. I want to know, did the chicken or the egg come first? Comment. What came first, the chicken or the egg? Because that's the argument with the AI play right now. What came first? In this situation, is it the commodities that are justifying the boom, that are being sucked up, that there's not enough to build these centers? There's not enough labor-crafted tradesmen to build this? What makes sense? Or somebody saying, the stock market doesn't make sense. The numbers don't make sense. They don't make sense, so I have to join it. What came first? In my opinion, pay attention to what's quiet. Short-term noise. You could see pullbacks in stock prices, right? That's not going to change the dynamic of where this is going. It's not going to. Sorry. Anybody that tells you one way or another, hallelujah. You want to follow them like a lemming off a cliff? Sayonara. I'm not going that way. I like being the remora. I like feasting on the sushi. Well, what came first, the chicken or the egg? It's so easy to talk about this because when you take a step back and you look at this, it makes sense. That's why the person with the largest trading account doesn't always win. The person with the most money under management doesn't always win. It's got nothing to do with this. Being right is how you win. Following your plan is how you win. I talk about so many things on our channel here, and if you get to this point, you should subscribe to the channel. We talk about things that most people probably say, oh, I joined the crypto public, but crypto, what? There's not all crypto. I got to unsubscribe to the channel. Do you understand you're hearing what's actually happening in the world and why? If you made it this far in the video? I have ADD. I can't listen to a video this long. I have terrible ADD, ADHD. Ladies and gentlemen, none of this is financial advice. It's my own opinion and a retained organization capacity. I harp on what's happening in the commodities market right now. That tells everything you need to know. It tells you everything you need to know where the world is going right now. I won't have an argument or a debate about what cryptocurrency is better and why. I love XRP, ICP, HBAR. Those are the ones that we love. There's reasons and logic behind it. But what we're hearing on the physical side from all of our concessions and refineries, the demand for things, and when we go over aluminum, copper, silver, nickel, sulfuric acid, when we go over all of these things for months, that's not going away, ladies and gentlemen. It's not. This content is for informational, educational purposes only, should not be taken as financial advice. Always consult your licensed financial advisor. Never invest based solely on watching a YouTube video. Do your own research. I love you all. I'm going to see you on the front lines every day, always. This is like the ending credits. If you go to the movies, you get to watch something. That's why I say, what came first, the chicken or the egg? You can have the biggest people sit there and say that none of this makes sense, who have the largest trading accounts, but that doesn't really matter, right? It doesn't really matter. Because as this race continues and things are being sucked up at copious amounts, what came first, the chicken or the egg? I want to see in the comments. Inside the Crypto Public Desk Monthly and the Patreon, I'll be explaining what we believe what came first and how we're going to take advantage of all this. And that's the most important thing. So don't get cut up like sushi. Get to Gucci conviction, to Gucci clarity. The frosty march off this frosty mountain, drinking our frosty beverage continues. I love you all. I'll see you on the front lines.